central banks were accumulating gold. They're going to continue to accumulate gold this year. More central banks are going to get in on it. And investors now are starting to realize that they need to hold gold and silver as opposed to U.S. Treasuries. I assumed when I first made that forecast that we would have a dollar crisis and it would cause that to happen, but it would also put the brakes on all the deficit spending and the quantitative easing. But none of that happened. And so we got away with doing it for another dozen years. And so now $5,000 gold isn't anywhere near where this is going. I mean, I don't really know at this point whether it's 20,000 or whether it's higher than that, but the bar has been moved substantially over the last dozen or so years based on all the money we've printed, all the debt we've accumulated.
Central banks are accelerating their gold accumulation strategies, driving a global pivot where institutional investors are increasingly favoring hard assets over U.S. Treasuries. This transition signals the end of the free lunch era of deficit spending, as the long-delayed dollar crisis finally begins to materialize, forcing the market to reevaluate the actual price of monetary stability. PeterSchiff, chief economist at Euro-Pacific Asset Management, argues that the window for a managed economic landing has closed. He emphasizes that his original $5,000 gold forecast was predicated on a crisis occurring a decade ago. However, the system's ability to kick the can for another dozen years through unchecked quantitative easing has drastically inflated the necessary revaluation price. Schiff warns that because of this prolonged period of debt accumulation, the bar has moved substantially, making $20,000 or even higher the new mathematical reality required to balance the massive expansion of the money supply. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
$100 silver, which we just broke through today for the first time ever, I think that's a much more significant milestone than when Bitcoin hit 100,000. Yet, there's no big silver $100 parties going on around the country. Nobody's really talking about it very much. And that's a pretty good indication that 100 is not the end. It's really the beginning. And silver is headed a lot higher. Gold, of course, is now about $30 away from 5,000. And if we don't hit it today, we'll probably hit it on Sunday night. When I first started predicting $5,000 gold publicly, it had, gone above 1,000. It was like 1,200, 1,500. Now, of course, I was making that prediction, 12, 13 years ago. And a lot of people, gave me a lot of shit because it didn't happen. Well, it's happened now. And sure, I made the forecast very prematurely. I didn't think back then that it would take this many years to get to 5,000. But the fact that it did take so long means that it's going a lot higher than 5,000, because I assumed when I first made that forecast that we would have a dollar crisis and it would cause that to happen, but it would also put the brakes on all the deficit spending and the quantitative easing. But none of that happened. And so we got away with doing it for another dozen years. And so now $5,000 gold isn't anywhere near where this is going. I mean, I don't really know at this point whether it's 20,000 or whether it's higher than that, but the bar has been moved substantially over the last dozen or so years based on all the money we've printed, all the debt we've accumulated. And, even if you bought gold, when I forecast it to go to 5,000, even if you bought it back then, you still did better than if you stayed in the S&P. So it wasn't like my advice cost you money just because it took more years than I thought to get to 5,000. You still, tripled your money, which was better than you would have done over that same time period in the S&P. So it's not like it was bad advice. And of course, we're not done yet. Gold's not going to stop at 5,000. So the gains are just going to continue, and people who own gold and silver will continue to make more money than people who are just sitting in the U.S. stock market. And the dollar's days as the world's reserve currency are numbered. Right? The world has kind of made an informal decision to abandon the dollar. It started last year as central banks were accumulating gold. They're going to continue to accumulate gold this year. More central banks are going to get in on it. And investors now are starting to realize that they need to hold gold and silver as opposed to U.S. Treasuries. So the world is trading in their dollars and their treasuries for real money, and that is a game changer. Especially for the United States, we've been living high on the hog with the exorbitant privilege of creating the world's reserve currency. That's enabled us to live beyond our means. That's kept consumer prices and interest rates lower than they otherwise would be. And it's allowed us to have this service sector, consumer-based economy. And it's allowed us to build up this massive Defense Department that Trump is bragging about. So I think what's going to be happening this year and next year is a major devaluation of the dollar relative to other currencies. That's going to lead to a significant increase in the cost of living in the United States. So the affordability crisis is going to be far more extreme than it has been. And it's not just consumer prices, but long-term interest rates that are headed much higher. We're headed for probably the worst economy that we've ever had in this country. Whether there's a get-out-of-jail-free card somewhere along the way with AI, we'll see. But in the short run, we have massive headwinds coming from de-dollarization, decades of living beyond our means. We have to pay the piper, right? The chickens are finally coming home to roost. And that's what you're seeing in the gold and silver market, right? It started last year with gold, expanded into silver. It's in the mining stocks. All the alarms are ringing. It's just that most people don't understand, what they're hearing. They don't get it. Just like, I was short the subprime market. I was in on that trade. When it blew up in 2007, I knew that a much bigger financial crisis was around the corner, that subprime was just the tip of a massive iceberg. But the mainstream, Wall Street, the Fed, Ben Bernanke, were saying, don't worry about it. It's contained. It's no big deal. It's just subprime. Was the warning of the financial crisis. And I had been predicting it for years. And as soon as we had the subprime, then my warnings got a lot louder. And I was like, look, this is going to be a disaster. You don't know what's going to happen. The banks are going to fail. Fannie and Freddie are going bankrupt. I mean, I knew what was going to happen. It didn't take that long from the blow up in 2007 to the crisis in 2008. Well, I've been saying that what we've seen in the precious metals market is the equivalent of what the subprime blow up. It is forecasting a currency crisis, a U.S. dollar crisis, and a sovereign debt crisis. And you can already see the beginnings of that. The yields on 10-year and 30-year treasuries are now higher than they were before the Fed, started cutting rates.
7 consecutive rate cuts.
Yeah, and the same thing happened when Powell was cutting rates when Biden was still president. He cut 75 basis points, and the long rates went up 75 basis points. Now they've cut another 75 basis points, and long rates have gone up again. And so the bond market is not cooperating because the bond vigilantes realize how much inflation is in the pipeline, and they don't want to buy those bonds.
The breach of $100 silver and the approach toward $5,000 gold represent a structural pivot in the global monetary order rather than a mere speculative rally. This quiet accumulation by central banks signals an informal yet decisive move to abandon the U.S. dollar, effectively ending the exorbitant privilege that has sustained the American service economy and suppressed interest rates for decades. Analysis clarifies that this price action serves as a systemic warning comparable to the 2007 subprime signals, acting as the precursor to a sovereign debt and currency crisis. It emphasizes that the bond market is already rejecting Federal Reserve policy. Despite recent rate cuts, long-term Treasury yields have risen, indicating that bond vigilantes are demanding higher premiums for inflation risk. The data warns that as the world trades Treasuries for tangible assets, the U.S. faces a severe devaluation of its standard of living, with the rising cost of capital exposing the unsustainability of decades of deficit spending. Let's get back to the interview.
What's happening now does not surprise me. Right? What surprises me is that it's taken so long, right? I saw this train wreck coming from so far in the distance that people began just calling me a stop clock and a perma bear because they didn't think the forecasts that I was making were panning out. They were panning out behind the scenes. But what's happening now is the mainstream is finally waking up to the reality of the fiscal and monetary situation that we're in and how it's going to end. There's going to be massive inflation, massive dollar depreciation, and the world is going to go back to gold and silver as the basis of our monetary system. I mean, Ray Dalio even said the same thing from Davos. He says that central banks are getting out of fiat, which means they're getting out of dollars. The monetary order is being reset. We're turning back the clock to prior to when the dollar became Bretton Woods, the reserve currency. We're going back to gold as the reserve. And this is a completely new ball game. The United States is going to have to experience a dramatic decline in standard of living because we were the primary beneficiaries of this system. And the rest of the world is going to see a burden lifted from their backs because they're not going to have to support the American consumer. Donald Trump has it completely backwards. The world doesn't take advantage of us. We take advantage of the world. The world produces, we consume. The world saves, we borrow. We've got the fun part. They've got the hard part, right? Donald Trump somehow thinks that we're doing the world a favor by consuming what they make. No, if we weren't around, they would consume what they make, right? What we're doing doesn't require any great skill, any capital, right? It's the fun part. Right? We just get everything. We cannot get to a viable economy without going through a protracted collapse of the phony economy we got now. And so that means a lot of people are going to lose money. Like Donald Trump, in his speech at Davos yesterday, he said he's very concerned about homeowners and he doesn't want them to lose their home equity. Well, we're in a bubble that they have to lose that home equity. I mean, it's not real. I mean, people can't afford to buy homes. That means the homes are not worth what people think because they're only worth what people can afford to pay. And if nobody could buy the house, then that's not the price. But prices have to adjust. Companies are going to default because they have too much debt. Lenders are going to lose money. So a lot of bad things have to happen before we can get the good things. But the politicians don't want any bad things to happen to anybody. So bad things are going to happen to pretty much everybody because of the crisis that they're creating. But when you ask me the question about, where this is going, because the institutions and investors are not involved, yes, they're just starting. They're just starting to get involved. And I believe over the course of this year and next year, you're going to see institutions that have had zero exposure to gold and gold and silver mining stocks are going to start adding that diversification into their portfolios. And as they do that, the prices of these stocks and metals are going to keep rising. And as they rise and the returns improve, that's going to attract more and more investor capital because the funds who don't have gold and silver in their portfolios or don't have mining stocks are going to underperform the ones that did. And that's going to put a lot of pressure. Like my fund, my dividend payers fund that I have, we had about a 20% allocation, 20% allocation to gold stocks last year. As a result, my dividend payers fund was up 62% last year, and it was the number one fund in its category of over 300 funds. And the category average was about 35%. We nearly doubled it. And one of the reasons we achieved that was by having an allocation to mining when our competitors had zero allocation, nothing. And so as we continue to outperform and we're killing everybody again this year, that's going to put pressure on our competitors. Hey, how are we going to compete with PeterSchiff or, we need to have some gold stocks or we're just going to keep falling behind. So you're going to see that happening throughout, mutual funds and hedge funds and endowments and pension funds. And eventually, of course, mom and pop retail investors, they're going to get into it. They're going to start getting calls from their brokers at, Merrill Lynch and who says, hey, I got a great idea for you. Newmont Mining, you need to get, this is what's going to happen. And so I haven't sold anything right into this rally. And the only reason I'm not personally buying into the rally is because I have so much now that I am, I'm just looking for
you got to
other
diversify a little bit. Well, let me ask you on that.
I've been buying emerging markets. I've been buying energy, stuff like that. Because I was so overweight gold and silver mining. And now I'm even more overweight because of how much these stocks have gone up.
The global monetary system is undergoing a fundamental reset that threatens to erode the U.S. standard of living, as the world rejects the exorbitant privilege of exchanging real production for American debt. While political leaders attempt to sustain asset bubbles like inflated home equity, the phony economy is facing a necessary collapse to restore viable pricing, marking a return to gold as the central reserve asset. Fund performance metrics illustrate the cost of ignoring this transition. Portfolios with a 15 to 20% allocation to mining stocks surged 62% last year, nearly doubling the category average of 35%. This dramatic outperformance clarifies that a massive institutional rotation is underway, as mutual funds and endowments are forced to abandon zero-exposure strategies to compete. The data emphasizes that as professional money managers aggressively bid for exposure to correct their underweight positioning, this influx of capital will drive mining stocks and physical metal prices significantly higher, setting the stage for a mania before retail investors fully enter the market. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.